Welcome to Empower Minds. If you've been following our financial series, you've learned about budgeting, saving, paying off debt, and taking your first steps into investing. Now it's time to put it all together in one powerful strategy: long-term financial planning. Imagine that your financial future is secure and that you're on your way to retiring comfortably or even achieving financial freedom in your lifetime. A question for you. Have you ever felt uncertain about your financial future or wondered how you can make your investments work for you in the long run? Today, we'll show you how to build a financial roadmap that will help you achieve security and lasting wealth. We'll share stories of people who have transformed their lives through long-term financial planning. Be sure to subscribe to the channel and activate the bell, because building wealth is a journey and we're here to guide you every step of the way. Don't you think we deserve your support? First, let's explain why long-term financial planning is important. Why is long-term financial planning essential? Financial planning isn't just for retirement, it's about shaping your entire financial future. When you make a long-term plan, you build a foundation for financial freedom. The freedom to retire, start a business, travel, or support your family. Let's go back to Warren Buffett, who didn't become a billionaire overnight. He started investing at age 11 and has held onto his investments for decades. The secret to his success is long-term thinking. Buffett says, "The stock market is designed to move money from active people to patient people." He focused on patience and steady growth over the years, turning modest investments into a massive empire. A question for you, dear viewer. How do you imagine your life in 20 years if you invest regularly like Buffett? Will you have the financial freedom to achieve your dreams? Long-term planning is your path to this freedom. Second, how to set long-term financial goals. 1. Start by defining your personal goals. Financial planning begins with what you want, your values, dreams, and goals. Some want to retire early, others want to secure their children's education or buy a vacation home. Write down exactly what you want to achieve. 2. Break down goals by time frame, short-term, 1 to 5 years, such as saving for a home or building an emergency fund. Medium-term, 5 to 10 years, such as paying off loans or expanding investments. Long-term, 10+ years, could include retirement, travel, or establishing a family legacy fund. Example of goal setting. Let's take Jeff Bezos, the founder of Amazon. He didn't set out to build a trillion-dollar empire in 1 year. He started with a small goal, an online bookstore. His vision evolved and his goals expanded over time, but the power of setting clear, evolving goals helped him stay focused. I want you to visualize your financial goals as a timeline. Write down one thing you want to achieve in 5 years, another in 10 years, and another in 20 years. Breaking goals down into steps helps you create an actionable plan. After we have learned the importance of long-term financial planning and identified long-term financial goals, we now reach the third stage, which is developing an investment portfolio to achieve long-term goals. Diversification means distributing your investments across multiple assets to reduce risk. Imagine that you own stocks, bonds, and real estate. When one sector declines, another sector may flourish, which maintains the balance of your investment portfolio. Let's look at Ray Dalio, founder of Bridgewater Associates. His principle is don't put all your eggs in one basket. He was able to achieve great success thanks to diversifying his investment portfolio. He mixes high-risk assets with safe assets to ensure the growth of his wealth in the long term. Growth assets, such as stocks, are ideal for achieving long-term goals as they provide high returns in the long term, even with short-term price fluctuations. Practical example. If you invested $10,000 in an S&P 500 fund 20 years ago, you would have about $54,000 today. That's the power of growth assets when given enough time. Bonds and real estate investment trusts, or REITs, provide steady income and balance risk. Bonds can be a safe option that reduces market volatility while stocks provide growth. Here's our advice. Think of your portfolio like a chart. Ask yourself, do I have enough growth investments for the future? Do I have enough safe investments to protect what I have? Write down one investment idea for each category. Now that we've developed our investment portfolio, we come to the next stop: strategies for managing risk and investing for the long term. It's natural to feel anxious when the market is down, but remember, the market always recovers over time. Instead of withdrawing your money, Think of market fluctuations as an opportunity to buy stocks at a discount. Let's go back to Warren Buffett and quote him an inspiring quote. Buffett says, "Be fearful when others are greedy, and be greedy when others are fearful." During crises, he takes advantage of opportunities while others are fearful. This strategy is based on investing a fixed amount on a regular basis, regardless of market fluctuations. When prices are high, you buy fewer shares. When they are low, you buy more. Over time, your average cost decreases. A practical example: if you invest $200 a month in a stock, sometimes you will buy more when prices are low, and sometimes you will buy less when they are high. This strategy takes advantage of market fluctuations without the pressure of timing the market. Now that we have learned all of the above, we come to the final step, which is monitor and update your financial plan. Think of your financial plan as an updatable document. Life changes, and so should your financial goals. Reevaluate your plan every year or after major events like marriage or buying a home. Real-life example: Oprah Winfrey built her empire by adapting her financial strategies to her changing goals. She started as a TV host, saved her earnings, then expanded into production and media, and over time her wealth grew significantly. Over time, your investment ratios may change due to market changes. Rebalancing means adjusting your portfolio to return to your original asset allocation, which helps you maintain a risk profile that suits you. Imagine your life in 10 years. Think about the financial stability, freedom, and opportunities you will have if you stick to your plan and review it regularly. Finally, remember that building wealth is not a sprint, it's a marathon. By planning for the long term, setting goals, diversifying wisely, and managing risk, you are setting the stage for a future of financial stability and opportunity. Remember, the most successful investors didn't get rich by chasing quick profits. Instead, they built their wealth through long-term focus, commitment, and adapting to change. You too have the power to build the life you want through smart financial planning. If you found this video helpful, don't forget to like, share, and subscribe to Empower Minds. Thank you for following along on this journey to financial empowerment, and we look forward to seeing you take steps toward your future with confidence and awareness.